Welcome to this presentation on valuation principles in small to mid-sized businesses. I'm Josh Hyman. The first thing I want to talk about when valuing a business is that we understand the fundamental equation. Okay? To value any asset, we take the free cash flow and we divide it by its risk, and that gives us our value. Okay? For businesses, particularly, what we do is we get the free cash flow to the firm, we divide it by a risk rate, and this is going to be the value of our company. Okay? So let's just take a quick second to figure out what this formula is telling us. Okay? If the free cash flow to the firm increases, then the value of the business should go up. If the free cash flow to the firm goes down, then the value of the business should go down. Okay. If the risk increases, okay, the value of the business will go down, right? If our risk decreases, then there's an increase in value. Okay. So we're going to go down and we're going to look at, different cash flows and different earnings for the owner. But we still want to remember our goal to value a company is to figure out its free cash flow to the firm and divide it by its risk rate. Well, now that we know that free cash flow to the firm is what we're after, let's take a look at some of the other cash flows that you may have heard of. Okay. The first one, of course, is EBITDA, right? And EBITDA is easy to get because we can get it directly from the income statement. Now, we do use in EBITDA multiples sometimes when we're using a comparable approach, but that would not be used. We do not want to use EBITDA for fundamental business valuation. And the reason is because it has a low economic value or correlation to economic value. Okay. And the reason is because it does not include our changes in working capital. It does not include our capital expenditures. Okay. So we really don't want to use EBITDA when we're fundamentally valuing a business. Okay. The other option that we might have is using the operating cash flows. Well, the problem with using the operating cash flows is it also has a low economic value. Okay. And the reason is that it does not include the capex. Okay. And these operating cash flows can swing wildly in small businesses records. Okay. So it's not a very dependable cash flow for us to use. The next one is free cash flow. Okay. And basically, what we do is we take the operating cash flow and we're going to subtract out the capex. Okay. So you can see these next three all start with free. The reason why they start with free is because they both take into capital changes in working capital and capital expenditures. Okay. The problem with using this one in private companies is that using historical capex and historical working capital is can be fraught with a lot of errors. Okay. Because capital expenditures tend to come in chunks, right? So we may be under or overestimating our capital expenditures if we're just getting it from a cash flow statement. These tend to work better if we're looking at, say, a public company. Okay. The next we have is free cash flow to equity. Okay. So what we do, you getting it this way, there's actually two different ways to get there. Okay. But using this way, we use the cash flow statement. Okay. And what we do is we end up subtracting out the debt payments. Okay. So we're going to take our capital expenditures into account, we take our working capital, and we take our debt into account. The problem is, again, is that using just the historical information on the records can lead a lot of errors to our estimates down here in working capital and capital expenditures. And just for that reason, we don't really want to just use the historical free cash flow to equity. Okay. So we want to use free cash flow to the firm. Okay. But what it does is it requires us to do a separate analysis. Okay. And this separate analysis is what's going to separate you and make you a valuation genius. Okay. So we're going to go through that. And the reason why we do it is because the reason why we want to get this free cash flow to the firm is because it's the highest correlation to economic value. Okay. So to get to our free cash flow to the firm and free cash flow to equity, Okay, we need to do it in 5 steps. The first step is we're going to forecast the owner's or seller's discretionary earnings. Okay, so we're going to add up all of the pay and benefits that the owner gets. Okay, then we need to make an estimate for the reasonable compensation for the ownership's contributed labor. Okay, this is what separates valuing small to mid-sized businesses versus valuing almost any other type of asset, is that we have to come up with this estimate of what is the labor contribution, what is the value of that the owner is giving to the company. Okay. Number three is super important, is reinvestment analysis. Okay. Businesses need short-term and long-term assets to generate free cash flow. Okay. And our job will be to figure out what's an average amount of annual reinvestment that we should anticipate, okay, to continually get the free cash flow. Number four is we need to calculate the tax liabilities of the business. Okay. And the reason why that's important is that because when we go to our risk rates, all those risk rates are on an after tax basis. So we want to get our numbers on an after tax basis. Okay. Now, when we're looking at these taxes, as I'll go through when we get there, these are corporate taxes. Okay. We don't really care what the individual tax rates are. We want to know so that way we can compare an LLC to a corporation or however they want to do their business. We're going to take their earnings and we're going to apply a tax to it. Okay, corporate tax. At this point, once we finish number four, we now have our free cash flow to the firm. Okay. But if we want to find the free cash flow equity, what we'll do is then subtract out the interest bearing debt payments. Okay. And then that would give us the amount of cash left over after paying any debt that we would owe. Okay. So we know that we want to get to the free cash flow. And our first mission is to get the seller or owner's discretionary earning, which you can see in this column here. Okay. Which is going to include all of the different add backs. Okay. So let's start with here. We start with net income, which is basically sales, cost of good, minus expenses, plus any non-operating income that's reported, minus any non-operating expenses that are reported. This gives us our net income. Okay. What we first do is we first find EBIT. And what we do is we add back the interest and we add back the taxes. And the reason why we're doing this is that we're going to possibly give the business a new capital structure. We don't want that to influence our numbers. Okay. So that's where we're going to add back this interest. Okay. And the same thing with the taxes. We don't really care necessarily about what they've historically paid in taxes. We want to know how the taxes are going to affect our free cash flow as an investor. Okay. So that's why we're adding those back. And then we go to define EBITDA, okay, which means we go to EBIT. And what we're going to do is we're going to add back depreciation amortization. And why do we add those back? Because those are phantom expenses, okay, phantom cash expenses that we have on our books to account for our long-term capital assets, okay? So this is actually cash available to the business, okay? So that's why we add that back. Then we get to adjusted EBITDA, okay? And what we're going to do is we're going to take EBITDA as defined, but we're going to add any non-recurring expenses that are in the financial statements, okay? So some of these may be reported in other expenses, okay? Some of them may not. Some of them may be hidden expenses that we need to add back, okay? That did not get listed. They got listed under here and under the main expenses. And for some reason, okay, we think that expense should never happen again. Okay. So we're going to add it back. Okay. Then we have our non-operating expenses. Okay. And these are probably the most controversial. Okay. Because these are expenses that the owner is saying that benefit them or themselves. Okay. A lot of times. Okay. So But it could be some others, like you could have, the kid's in college and he doesn't do a lot of work, but he's paid some money. Okay, maybe that could be an operating, non-operating expense, or maybe the he uses the his vehicle for half the time for personal use. Okay, so it could be non-operating expenses, so things like that you have to filter through. Okay, and then we have the last thing's owner compensation. Okay, so this is going to be, of course, the net income. So we're going to add all of this, but we're going to also add, their salary that they're paid. Okay, and then any other type of perks that they get. Okay, and this is really, we spend a lot of time focusing on these last three. Okay, because like I said, that really is the heart and crux of doing a small to mid-sized business valuation, is coming up with these. Okay, and the difficulty about it is that according to the IRS, okay, there are over 18 ways a business owner can compensate themselves outside of salary and dividend or profit distributions. Okay, so we want to go back and kind of be looking for these things that we can that are clearly a benefit to the owner. We want to make sure we add them back. Okay, and what I've done, because I could probably do an entire lecture just on these normalizations, I've written an ebook that you guys can get for free, and that will basically go through all of the different types of adjustments, go through all these different type of assessments here, and how to find them. Okay. So we're going to assume right here, we're going to assume that we have done the changes. Okay. And what we'll do is we're going to look at the earnings of, for the past few years, and we need to forecast what we think that number is going to be. Okay. So our first job from doing all of those adjustments is coming up with the owner's discretionary earnings. What does the ownership or the ownership group, what do they get as a whole? Okay, that's what we're looking for in this first estimate. Okay, so once we've got that, it's now time, now that we've added everything back that the ownership gets, we now have to subtract out their labor. Okay, and that's what we're going to be doing here with reasonable compensation. Okay, so what are we looking for in this estimate? Okay, we are trying to replace the owner with what it would cost to replace them with an employee, essentially. Okay, because business owners, they get two types of income. Okay, they get income from the labor that they can contribute, and they generate income or dividend income from being a business owner. And our job right now is to try to separate those two. Okay, so it's important to keep in mind, okay, that you could have two owners in the same industry doing the same sales. Everything could be the same, but the owner's skills that they give to the business are completely different. Maybe one of the business owners is the top sales guy, and that's how he drives sales. The other business owner, he's a big operations guy. He hires all outside sales guys, they do all of it, and he does internal management, right? So we're looking for those skills that they can contribute and trying to put a price tag on it, per se. Okay. The other thing we want to do is also, like I said, we want to look for their responsibilities. Okay. How many people are they managing? Right? What almost every business owner that has an employee has to do some type of management, right? So how much time is spent managing and training other employees? All of that stuff should be taken into account. Okay. And then third, which is time commitment. Okay. Because just like you have two owners in the same industry making the same money, you could have one owner that, hey, to keep the business rolling, he's got to work 50, 60 hours a week. Okay. Whereas you could have a business owner where they're essentially semi-retired, right? They essentially go in a few days a week. They have people running the company, and it's just a real great situation for them because they don't personally have to give a lot of time, or time that they don't have to do things that they don't want to do. Okay. And we can then make that adjustment. So adding their skills, their responsibilities and time commitment should give us a pretty good estimate for reasonable compensation. Okay, so what we do normally is we try to look at the most granular, salary information that we could get. Try to come up with some type of range, right? Looking at, hey, if we can get regional information, that's obviously better than not, right? Because you don't want to be, if the business is in California, and they're like, hey, the national, pay is 72,000. Well, it probably could be higher. It most likely is going to be higher in California, right? So we may need to. You have to bring those adjustments when you're coming to the table. Okay. So get, again, like I said, granular you can, and then you make your best estimate on what you think those skills that he attributes or they attribute are worth. Okay. So again, we've added all the discretionary earnings backs. Now we think in our estimate that this is the amount of reasonable compensation that the owners have given. This now gives us our new adjusted EBITDA. Okay. Now, with this EBITDA, okay, here, okay, now that we have EBITDA, okay, now, excuse me for flipping forward, but here's the EBITDA, okay, we now, for our taxes, because what we're going to need to do is we've got to come up with our depreciation and amortization estimate, okay? So let's figure out how we do that. And to find our depreciation and amortization, we have to look at our step 3, which is reinvestment analysis. And this is extremely, extremely, extremely important. Okay. It's asking how much cash must be reinvested to continually generate the forecasted free cash flow. So that is the question that we are trying to answer here. Okay. Because what we'll do is we need to get our estimate for capital expenditures first. Once we have our estimate for capital expenditures, we then tie those expenditures to our depreciation, okay, which will give us our depreciation. Then we're going to look at instead of looking at the long-term assets, which capital expenditures account for, we're going to take a look at the short-term assets, the current assets that we need to have, inventory, accounts receivable, etc., in our growth and working capital. So let's first talk about capital expenditures. Okay, so capital expenditures can come in a whole different variety of types of expenses depending on the type of business. Okay, so the easiest definition is obviously machinery and equipment. I mean, that's what the accounting system was built for, is to handle capitalizing machinery and equipment and then slowly depreciation over time. Okay. But we also need to account for leasehold improvements. Okay. Especially like restaurant retail and a lot of retail. There's always a lot of leasehold improvements. Okay. So those are going to be capital expenditures. Obviously, today, technology and software can be big, expensive costs. Okay. That we may want to capitalize over time. And of course, intangible assets. Okay. So if we purchase a patent, a license, these are all long-term assets. And again, what we're looking for is we want the average. Okay, what is the average amount the company must put back in every year to continually generate that free cash flow? Okay, so what we do is we always want to make sure that our capital expenditure and depreciation ratio are in line with each other. Okay, because you won't believe the amount of reports that I get that I see where somebody has put depreciation higher than capital expenditures. And that doesn't make any sense. Okay. You're depreciating capital expenditures. Okay. So let's just walk through. I like to use this model as a simple exercise. If we think that there are $2 million in long-term assets are needed, okay, we think the average life of these assets is 10 years. Okay, so that's going to give us an amount of a capex like $200,000 a year, right? Okay, well, based on that growth rate of when we're going to need to replace that, we can basically create a ratio of the depreciation and capital expenditure. Okay, so in this case, 200,000 would be our estimate for long-term assets. Okay, and then we're going to now attach that depreciation to our capital expenditure so you see it's in line. Okay, so you have to always get the capital expenditure estimate first, then you can do your depreciation estimate. Okay, now let's talk about the growth in non-cash working capital. Okay, so of course, a business may need accounts receivable, inventory, and other prepaid assets. Okay, and those represent cash outlays. Okay, that could otherwise be distributed to business owners. And if it could be distributed to business owners, it would be free cash flow. But it's not because we need cash for the working capital. So we're going to add cash for accounts receivable, inventory, other current assets. Okay, but then we also subtract out what we think the average payables could be. Okay, because a company is usually able to get some services delayed, right? Delay on the payment. Okay, so we'll subtract that. So we end up calculating what the non-cash working capital estimate is, and then we grow it by the long-term rate, and this gives us a required annual estimate. Okay, so now we've got all three parts of our reinvestment analysis. Okay, so we're going to take our EBITDA and we're going to subtract our estimate for depreciation and amortization. Okay, and we're going to do this. Okay, which is going to give us EBIT. Right now we're going to get to EBIT. Okay, what we do from EBIT is then we need to apply the taxes. Okay, so EBIT depreciation and amortization gets subtracted, so that's not tax because that's not taxable income, that's an expense, right? Then we get to EBIT, and then it's a good reputation because I work here in the U.S. most often that I apply state tax, and then I apply federal tax, okay, and then this gets us down to NOPAT, okay, net operating profit after tax. Well, what we're going to do is then we add back that depreciation. Okay, why? Because this depreciation is a phantom cash expense, right? So we're going to add it back, okay? But then we're also now going to we're going to subtract our growth in working capital, okay? So that's our estimate. And then we're also going to subtract our estimate for capital expenditures, okay? Once we've done these adjustments now with our reinvestments, we now have our after-tax cash flow to the firm, okay? And if we want to get the free cash flow equity, we would just subtract any interest-bearing debt payments, okay? And just like that. But free cash flow to the firm is our main goal, and we've now achieved that. So just to jump back to our fundamental business valuation to see where we're at, okay? We've got our numerator for free cash flow to the firm, okay, for business value, okay? We're now going to talk about the second part of the equation, which is risk. This is a capital market line, okay? And basically, it's just a simple representation of low risk investments to higher risk investments, okay? And you'll see, we start down here with cash and treasuries, right? These are traditionally and thought of, okay, because you can still take losses in cash and treasury through inflation and other measures, okay? But it's typically considered low risk, low return, okay? As we move up the ladder, here we are at the S&P 500, okay? Well, we would consider that somewhat of a medium return to medium risk level, okay? Now, once we get past this S&P 500 here, okay, we're now going to enter into the private markets, okay? And the majority of time, okay, other than some, real estate bank loans, the majority of this over here, it requires you to be an accredited investor. So they let normal people invest here, okay? They want you to be educated to invest up here, okay? So, and let me say this, the majority of small to mid-sized businesses that we value typically flow somewhere here where private equity means a firm that produces very healthy free cash flows and consistently. Okay, that's going to be a private equity company. So technically, it has a lower risk profile. Okay, but it doesn't have liquidity. right? Because it's much harder to sell a private company than it is to jump on the computer and sell your S&P 500. Okay, so that's where the risk lies. Okay, venture capital is kind of like where the business may have some sales, it may have some started, but it's definitely not in free cash flow land. Okay, so it is a much higher risk, higher return scenario. Okay, and an angel investment I like to put here is kind of like investing in companies that have no history of sales. So you're essentially, have no history of the business, and you basically are bringing the idea, similar to the entrepreneur, right? You're starting with the idea, and now you're going to run with it. It'll move down this chart as it produces more free cash flow, okay, or the risk lowers, okay. So, what we do to find our risk rate is we call it the capitalization rate. And we use the build up method for private businesses. Okay. What we do is we start off with the risk free rate, okay, which is almost always automatic, a 10 or 20-year treasury. Okay. That's just our basic finance. We always start with that. And then we get the equity risk premium. Okay. And what the equity risk premium is telling us is how much do those S&P 500 investors, what are they expecting? Okay, what is the expected rate of return? Okay, and we can find these fairly easy. Okay, the next premium that we look at is the size premium. Okay, and the rationale is that if we break all of the stocks down from the largest companies to the smallest companies, we do find that the rates of return are higher for these smaller companies. Okay, so that somewhat, and with the same coin, it also implies higher risk. Okay, so we're adding that to our risk profile most of the time, because why? The companies that we're valuing are small. Okay, even on this 10th decile, the average company is like $189 million. Okay, so that's considered a small company in this size premium. Okay, now the next one we'll do is sometimes an industry premium or discount. Okay, so if we have good data and a company is in a mature industry, okay, or industry that we can get lots of data on, is definitely we definitely use an industry premium or discount. Okay, but some smaller size businesses, they kind of operate in these somewhat, sometimes new markets where we don't have like tons of data on industry premiums and discounts. So in that case, sometimes we just leave it out. Okay, if we can't identify why we think it's an industry premium or discount, then we just leave it blank. Okay. And then what's great is we have country premiums now. So we can look at, okay, we're doing the same, we're doing the same thing, but now we're going to add in country risk. Okay. So a company like Australia or the United States is going to have zero. Okay. Whereas a country, like Argentina and some of the others, they're going to have much higher discount rates, which you need to attach to the cash flow. Why? Because there's all kinds of political instability, currency instability, a whole lot of things, and that's what our country premium is going to account for. Okay. Now, all of these premiums come from the public markets. Okay. The last one is really the company specific risk premium. Okay. What we're doing with this one is that we're going to actually look at the business, and then we're going to go through a survey and basically attach risk based on the individual characteristics of the company versus the market. Okay. Adding them all together, we get our after tax net cash flow discount rate. Okay. And then what we'll do is we're going to subtract out the long term sustainable growth rate, which I always recommend make equal to the risk free rate. Okay. And then that's going to give us our after tax net cash flow capitalization rate, which is going to be the denominator in our equation. So define, like I said, the risk-free rate. I always recommend using the 10-year bond. Why? Because it's been around for more than 100 years. It's essentially the most stable bond yield that we have, and that's why I like to use it. Okay, so you can see here, if I was valuing a company in the U.S., well, we're always going to start with U.S. risk-free rate, right? So 4.15 here. Okay, and then we look up, like I said, the cost of capital. Here we're going to go and look up here we're going to use the Kroll. Okay, and Kroll recommends in the USA that our equity risk premium is 5.5%. Okay, so basically, what we'd be doing to find the stock market average, we'd add the risk free rate 415 to this 5.5, so you'd be around 9.5, 10% somewhere. That is what the market is priced in, what they think you should gain if you invest in the S&P 500. Okay, so if we go back to our thing here, the S&P 500, this is what right now is telling us is they want anywhere from like 9 to 10% return. Okay, that's where we are. So anything above this, okay, we should be commanding a higher risk above that. And again, here we go to the size premium. Okay, we can go look it up at the cost of capital professional. They break it out. Okay, we have 2,000 firms. Okay, they're in between. The lowest is 1.9 million, and the max in this size is over a very large number if you add the zeros. Okay, like 2 billion. Okay, so that's what I'm saying. That we're valuing companies that are lower than this. Okay, so it makes sense as you seeing the rate of return here. It's getting larger based on the risk profile. Okay, and then again, we do the industry. A lot of times, we look at Professor DeMonaran. Basically, he does a big study on the on the betas, okay, of the industries, and then it's looking and trying to identify the risk. The problem is that there's a limited amount of companies, that you can look up here. So it's not the greatest, but I always include it if I have the data. Same thing with a country risk spread. Okay, so you can see, like if we look at a country like Abu Dhabi, we'd add a very minuscule risk rate, 0.72. Okay, but if we're going to do Albania or Algeria, okay, you can see it's a pretty good significant increase to the risk premium, right? And if we get down here, we see even more risk, where Argentina would add 17.55% to our risk rate. So that obviously makes a big difference in country location. So again, once we're going to go find our risk free rate. We're going to go get our equity risk premium, our size premium, our industry premium or discount, our country premium. And now, like I said, we're going to also look at the company specific risk premium. Okay, we add that. That gets our after tax net cash flow discount rate, subtracted by our long term sustainable growth rate, and that gets us our net cash flow capitalization rate. Now, let's talk a little bit about, about the company specific risk. Okay. And what we like to do at Business Valuation Advisors is I have 7 categories that I like to look at. Okay. And let me just go through the first few. Okay. Owner dependence is a big deal in risk, right? So through my survey, will try to figure out how dependent is this business on the owners. Okay. Another very big one I look for is I'm going to look for the concentration. Is there any supplier concentration, customer concentration, employee concentration? So, is there any concentration that would add risk? Okay. And then another big one is obviously growth potential. Okay. So, does the business take a lot of capital expenditure to grow? Okay. Or is it more nimble where we can open up markets, at a faster rate? Okay, maybe it's through the internet or something, software. I mean, those businesses have easier growth paths than say, okay, if we open up another gym, that's going to take a very substantial capital investment to do that. So those are other things we're looking at growth potential. Okay, but these 7 metrics eventually give us a score, which then we can assign to our risk rate. And to go a little bit deeper into company specific risk premium, I've also written a guide on that. Okay, so kind of walk through the 7 things that I like to look at, the ways that I do it, and then can help you coming up with that risk premium. Okay, and again, Now we would add this risk premium to our discount rate. Okay, subtract out the long sustainable growth rate. Now we've got our denominator capitalization rate. So again, let's just remind ourselves we've got the after tax free cash flow to the firm here, and we've got our risk rate. Okay, so if we take the 1,022,647, we divide it by 21.9, that gives us an intrinsic value of $4.8 million for this business. Okay. Now, just to make sure that we are correct, a lot of times what I will do is I will also calculate the pre-tax free cash flow. Why? Because most investments in the private market, in fact, all of them, are benchmarked on an after-tax basis. Okay, so I will use the after-tax discount rate so that I can measure against what um, the different data that we get from the private markets, but then I'm going to use the different cash flow. I'm use the pre-tax cash flow. Guess what? It's the same thing, 4.8 million. Okay. And some owners, free cash flow is a foreign language to them. But most of them will understand EBIT, right? So sometimes what I'll do is I will take EBIT, and then I will use the rate of return for, if we were using the stream, an EBIT stream, and we're going to have 1.6 million. We divide it by the higher discount rate. Guess what? Our intrinsic value is exactly the same. Now, here's where I think a lot of times, and I think the internet and a lot of resources out there are very confusing. So I'm going to try to do my best to clear it up here. Okay. We have three types of business value. Okay. The first one is fair market value, okay, which dominates 99.9% all the information that you'll ever read about buying or investing or selling a company. Okay. Then we have fair value. Fair value is really for um, legal content in terms of financial reporting. Okay. There's some state jurisdictions where they have fair value, but most of the time it's for financial reporting purposes. And the third one is investment value. This is value to an individual buyer, okay, where deal structure and debt financing and all kinds of variables can come into play, okay, to find investment value. So let me just break down again quickly without having to read those. Let me break it down again, okay? The big assumption with fair market value is that the value of the business is as if the transaction is all cash. Okay. So what we just did in our previous evaluation is we found the cost of equity for our company. Okay. That assumed that we were going to use 100% equity to purchase the business. This is needed a lot of time in tax, in litigation, and other metrics were there where, yeah, if we're going to, you know, split something, we need to know the all cash value so that we can split it. Okay, that's the majority of the time. And again, fair value is for financial reporting, and investment value is going to have deal structure, and we're going to see example of debt financing. So let's now look at investment value, because a lot of you, and obviously I work big in the M&A space, and I know a lot of you are interested in M&A. Okay, so what happens when we're looking at investment value is that instead of using just the cost of equity, we're going to use the weighted average cost of capital. The weighted average cost of capital is, it's not that difficult. Okay, it basically means how much cash equity are we going to use to buy the business, and how much borrowed debt are we going to use to buy the business. Okay, that combination, okay, is going to give us our new risk rate. So let's take a look at the business that we just valued. Okay, we found that the fair market value was $4.8 million for this business. Okay, what's going to change now is that I'm going to add in an interest rate of 8%, and I'm going to add in financing for 120 months. So let's say, for example, that the owner that's selling the business is going to take a 20% down payment and they're going to finance the other 80%. Okay. Now, that may not be a realistic example for everybody, but I want you to do it so you can see the difference in the numbers. Okay. So here we've got 8% at 120 months. Okay. But nothing else has changed about this deal. Okay. So, except for that debt right there. Okay. Now let's look at the difference. Our financing value, okay, now by adding in the debt, lowered our risk rate, okay? And by lowering the risk rate, I've increased the business. Because remember, there's two ways to increase the value of the business, right? We increase the value of the business by increasing free cash flow. Well, we didn't increase free cash flow in this situation, okay? Or we changed the risk rate, okay? And by changing our risk rate, we now have changed the value of the company, right? Sorry about that. Okay, so now our difference, this is difference of $3.4 million. And not chump change. Okay, that's a big difference in value. Okay. Our down payments have changed. Okay, why? Because in this scenario, we were putting down all cash. And in this scenario, we're only putting 20% down of the purchase price. Okay. And that difference is here, $3 million. Okay. Now, the seller's discretionary earnings has also changed. Okay, so if we pay all cash, this is all the earnings that we're going to expect to make, right? Well, we're not going to make as much earnings. Why? Because we need to pay the debt off. Okay, so part of our money is going to paying off that debt. But here's the magic is that we make the same rate of return either way on the deal as a buyer. Okay. So one of the successes I always had of trying to get businesses financed is that I will go in and sometimes offer the seller multiple deals, right? And I'll say, hey, which number do you like better? And they always go for these big numbers. Okay. Well, and I say, well, it includes you financing the deal. Okay. And that can be a great win-win solution. Okay. The owner gets more money. Okay. And you have less to put down. Okay. But let's also remember about this is that we had 8% interest. Okay, so while the note is outstanding, the seller is also earning interest, and if they keep the note until maturity, look at this, they end up with $11.2 million. Okay, that's a difference of over $6.4 million in value. Okay, so the definitions of a business, fair market value versus investment value, is a big deal. Now, we have found the intrinsic value of the business. Okay, unfortunately, our job is not done. Okay, and the reason is because businesses, and especially private small to mid-sized businesses, okay, are made up of a coalition of assets. Okay, and how we come up with the business value is that we need to find a normal level of operating working capital. That's got to come with the business. Okay. All of the physical property, plant, and equipment that is used to produce free cash flow is included in our intrinsic value. Okay. So an error I often see a lot of times is they will value the company by a multiple and then somebody's adding on the equipment. Okay. That's wrong. Okay. It would only be added back if it's a non-operating asset. Okay. So let's say, for example, in this scenario, the business owner has their personal vehicle here. Okay. Well, if the personal vehicle, that's not being used to generate cash flow, right? We could move that to non-operating expenses. Or let's say they have a vacation home, right? It's possible that that property can get moved in here. The same way with operating capital. If the business has excess cash, or it has securities, it doesn't need those assets to run the business. So therefore, it gets moved down here, okay, into non-operating assets, okay. But let me jump back up here. Okay, so we have operating working capital, property, plant, and equipment, and now we have any identified assets, meaning we have on the balance sheet, okay, we have intangible assets like a license, a patent, something we've recognized in the financials. Okay, so we add these three, and then we compare it to our intrinsic value. Okay, And whatever the difference is, positive or negative, is our goodwill. Okay. And this goodwill is going to be the fruit of our labor, as you're going to see. Okay. So whether we use fair market value or investment value, that's going to be the intrinsic value of the business. Okay. We then need to have normal amount of operating working capital, normal amount of property and plant equipment, the intangible assets that have been identified. Then we compare that to the goodwill. We take the intrinsic value and then we add any non-operating assets that the business hold. This gives us our enterprise value of the business. Now, let's talk about goodwill, and let's talk about how these businesses are priced. Okay. Let's assume, all right, let's assume that you're approached by a business broker. Okay. We find that the physical assets are uh, about 1.5. Okay. And then we find our goodwill plug to be 750,000. Okay, so we've added these back up, and our plug happens to be 750,000. Okay, let's see how the price of the business is going to change, and the goodwill is going to be the anchor for thousands of deal prices. Let's watch how this happens. Okay, let's assume that the first deal is a stock sale. So what is the buyer buying? The buyer is going to buy all of these assets. So there's 521,000 in current assets. He's going to buy all of these property and equipment assets. And we found by doing our evaluation that our plug is 750,000 is the goodwill. Well, what should the purchase price should be? The purchase price should be 2.8 million because that's what the buyer's buying, right? He at the close, right? He's owed 2.8 million, right? No assets that are kept by the seller. There's no liabilities paid off by the seller in this scenario. So the deal should be 2.8 million. Okay. Let's look at deal number two. Deal number two, the investor is keeping all of the current assets. He's going to keep the cash. He's going to keep the accounts receivable, and he's keeping the inventory. Okay. So what is the buyer buying? The buyer is going to buy 1.5 million of property, plant, and equipment. Okay. And he's going to buy $750,000 of goodwill. So what should the new purchase price should be? New purchase price should be $2.2 million. Okay. But if we look down here, okay, the seller is going to net the same either way. He gets $2.2 million at closing, plus he's keeping $521,000 of assets, which equals 2.8 million. Okay. And just to reinforce this, look at deal number three. Okay. Let's say deal number three, the owner keeps all of the cash. Okay. But the buyer is going to want to take over. He's going to take the accounts receivable. He's going to take the inventory this time. Okay. Well, how many current assets is he acquiring? 406,000 plus all the property, plant, and equipment, plus the goodwill. We're just at $2.7 million. Okay. But if we go back and look, now the buyer has buying the business $2.6 million in assets, right? That the seller is selling, plus he's keeping 114 of assets, right? Because he's going to keep all his cash. He nets exactly the same as the other two deal structures. Okay. And that's why we value companies this way. Okay. And that's why we isolate the goodwill, because in a deal structure, if you've been around M&A, deals can go all kinds of different combinations. Okay. But as long as we have the goodwill anchor, we can figure out what the price is, and the net should be the same to the seller in every deal scenario. Now, let's also talk about what happens a lot in M&A and how to close more deals. Okay. And there's three type of incentives that I often found that work for me in the past and a lot of clients. And so I'm going to review them here. Okay. One of them is to use an owner financing balloon. Okay. So sometimes, okay, maybe in the scenario, what I would do is, Maybe we're going to amortize, like for example, in this um, example here, we're amortizing we're amortizing 120 months. Okay, but the owner doesn't want to wait that long to get his money. Okay, well, what we can do is we can put in a balloon payment that says, hey, in the final year of the balloon, I'm going to give you a cash payment. Okay, so the buyer would save up money or get an additional loan to cover the balloon payment. But in those crucial, first years, the business is not overly stressed with the debt payment. Okay, so that's a lot of times how we use the balloon to close a deal. Okay, another super useful and important one is earnouts. Okay, so normally they're going to be on revenue or EBITDA. Obviously, sellers like revenue and buyers like EBITDA, so it's usually negotiated, right? But it's for a number of years, and that because it's very rare that you can get a buyer and seller to agree on price, and they just the buyer feels like a lot of risk, and the seller feels like they're leaving too much on the table. So a lot of times to get the deal done, it's in the rub, saying, okay, what are the incentives in the contract that we can do to make the seller happy and give us and make the buyer happy at the same time. Okay. The other one that I found that works sometimes really well is consulting fees. So having the business owner stay on or continually having a way for them to get paid is another way to sweeten the deal. Okay, so instead of having to bring the cash up front, you're basically saying, "Hey, I'm as every month or 2 weeks or whatever, I'm going to pay you out for your consulting services," and that can sweeten the pie. So using all of these deal incentives can give us a total deal consideration and close more deals, right? Because you have to use these tools a lot of times. If you're just going to find the intrinsic value and the seller says no, very hard to close on a business deal that way. Okay. Now, while all of these deal scenarios, they're all easy to drop on paper. I mean, you can just be like, hey, okay, if the business hits, $13 million, I'm going to give you X amount of money. Okay. All of that is very simple to drop on paper. What we need now is we need to use kind of an advanced discounted cash flow model. But what we need to do is when we put those incentives in place, we now have to run the model to make sure that it makes sense for us as the investor. Okay. And that's when we're going to look at the net present value. We're going to look at the IRR. We'll look at the payback, and we'll use these metrics, after putting in these deal incentives to make sure that the deal still makes sense for us. Okay. So that's what we'll do. That's what we do on the back end for a leverage buyout. Okay. The other thing that we have to model in sometimes is for a private equity company. Okay. And in this scenario, what we're doing is they're still doing a leverage buyout. Okay. But the sponsors are going to, the limited partners, okay, are going to come in and give investment to buy the company. Okay. So the private equities firm's job is to take over the business, to increase its value, and to bring back the return to the investor. Okay. So a lot of times what we need to do is we need to come up with the different tranches, okay, because there'll be different hurdles that if the fund meets, then the fund sponsor gets a little extra money. And that's why the hedge fund and private equity guys make so much money, is because they get that carried interest. Okay. As they make their investors a higher return, more cash flow split goes to them. And that's what this distribution schedule is going to account for. Okay. The other thing is what we'll do is we will often make a cash flow summary. So I want the investor to know, look, hey, I'm not going to be paying myself out or the management for this long, but in year 5, that's when we're planning to sell, and these are what the cash flow distributions should look like, right? So it's just a simple way of letting the investor kind of know where's the cash, who's it going to, and what do we anticipate, okay? And the last thing we have to do now is, especially if we're including all of those deal incentives, okay, is we now need to put in possibly management fees, due diligence fees, professional fees. There are a lot of costs that go into buying a business that fair market value doesn't give us. Okay, so when we're computing these IRRs for the investors, we're showing them after our fees, after money has been split out to management. And that's a good point. I should point out. A lot of times, there's a lot of private. All the waterfall modeling seems to be big on the internet on real estate. Okay, and real estate has a lot of the same fundamentals as private equity. One of the big differences, though, is in private equity, we always want to split out the cash, usually to have management, okay? Because we're going to have people and employees, and they need to be incentivized a lot of times to, perform. So, we have to break down that dilution, right? And how that's going to affect the rate of return to the investor, okay? But I hope that you have enjoyed this presentation and have gotten a lot of use out of it, and learned more to value private business. Feel free to visit our website at valuationadvisor.com to learn more. We have valuation services and courses that you can take to dominate the M&A game. Thanks so much.